Good morning and welcome to The Street on BNN Bloomberg for a Monday morning. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Michael Hakes, Senior Portfolio Manager at Murray Wealth Group, will be joining us for the hour in 30 minutes. We'll discuss the latest OPEC Plus meeting over the weekend with Stuart Glickman, Energy Equity Analyst and Deputy Research Director at CFRA Research. And of course, we always want to hear from you on First Call. Reach out with your questions on global equities, and we'll have Michael answer as many of them as he can at the end of the show. Number to call is 1-855-326-6266. We'll open the phone lines in about 30 minutes, and our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you here in the BNN Bloomberg newsroom. Well, the U.S. is denying an Iranian media report that Tehran hit an American naval vessel with missiles. It happened hours after U.S. President Donald Trump said the U.S. would help ships stranded in the Persian Gulf transit the Strait of Hormuz, calling it a humanitarian gesture. The plan left ships confused with very few details. In response, Iran's military said U.S. forces would be attacked if they entered the strait. OPEC Plus nations have agreed to slightly increase crude production next month as the Iran war continues to affect global oil supply. The virtual meeting happened on Sunday, the group deciding to raise production by close to 200,000 barrels a day. However, the move is mostly symbolic until the Strait of Hormuz is fully open. This will be the third consecutive monthly increase by the bloc. It comes after the United Arab Emirates' surprise exit from the bloc. Discount American air carrier Spirit has shut down operations. Spirit says the move follows failed efforts to restructure the business and secure funding. Sharp rise in fuel costs and other pressures worsened Spirit's financial position, leaving it without enough capital to continue. Airline operators' bankruptcy leaves thousands out of work and thousands of passengers as well, stranded. And now our top line story. U.S. futures are under pressure. And you can see it's kind of condola. And then you look at the oil at the bottom there. You got a mix on the stocks. Not sure what's next, what to believe. But oil's believing one thing, that maybe there is something going on. And it's jumping again. All these tensions in the Middle East taking focus off hot big tech earnings. The move followed reports from Iranian state media claiming missiles struck a U.S. patrol boat, a claim that briefly deepened losses before being flatly denied by Washington. Let's discuss how it impacts the investors with the guest for the hour, Michael Hakes, Senior Portfolio Manager at Murray Wealth Group. Michael, thank you very much for joining us as always.
Hey, Roger. It's great to be here this beautiful Monday morning.
It is a gorgeous exciting. Monday morning.
And almost the news flow out of Iran is, not unexpected and almost as exciting as last night's Montreal-Tampa game. But always a moving target here for us. But as you know, the Iran leadership, I think, is fragmented, it's in flux. We don't really know who's in control. Trump clearly, I think, wants de-escalation to be in de-escalation mode as we move toward the midterms. Gas prices hitting $4 a gallon down there. Consumers are clearly under duress, paying that much money for a gallon of gas. So it's a fine tightrope that we're walking towards the midterms here with Iran.
And what do you do with today's news? I mean, the markets, we saw a spike. We saw oil is up slightly. The markets dropped. Now they've kind of, their mixed futures are mixed. Europe, I'm just looking, they're all down slightly now. How does anybody respond to this on a daily basis, or do you step back?
Yeah, that's a good point. I think you have to step back and try and take some deep breaths. I think in a month, I think there was reported last week, a month is really when rubber hits the road in terms of, so to speak, in terms of actually having no gas at the pumps, especially in Europe, and jet fuel and that sort of thing. That's when all the reserves run out. So that's when things will really escalate in terms of product being not there, as opposed to the speculation we're seeing in terms of moving tankers in the Strait of Hormuz.
And what are you doing with all this? How are you working through this?
Well, we have two funds. our income growth fund, which is more Canadian based, has some exposure in the oil space, and these guys have had some good moves up. So that fund has been benefiting from that over the short term. Our global growth fund is more exposed to your point earlier in terms of the reporting earnings last week and the group of seven, as they speak of, the Amazons and the Microsofts of the world, which have been weak year to date too, mostly to speak. So this is a lot of, hopefully it's going to be noise, this oil thing, but it's concerning over the long term in terms of potential global recession if this drags out. The U.S. administration is a huge wild card in terms of what they're going to do. It's tough sledding.
Well, yeah, I think Iran is a wild card. Is there a kind of a date for you that if this isn't resolved, it's like it does get serious? Is it when I think we talked. Weren't the Europeans supposed to start running low on jet fuel this month, and now it's next month? It's so hard to interpret what's true, what's not true.
It's hard to know that no one really knows. People must know. The airports know. You've seen the airlines, Lufthansa. Some of the big players in Europe have been reducing their flights for shorter flight durations in anticipation of this, to make sure that their international flights stay going. So I think we're this next week, as you see Trump offering this Project Freedom to help ships through the Strait of Hormuz. We'll see a path to loosening up that region for traffic.
We had Iran say that they struck one of the ships out there, the American ships out there. America said, no, nothing's been hit, nothing's been fired on. If it looks like a bluff and the U.S. actually Iranian bluff, how do you think the markets respond? Or have they responded already over the last month?
I think they have. You've seen oil go up slowly every day as there has been no reconciliation of the issues. But I think the market seems to be taking it pretty well, given the importance of the Strait of Hormuz for oil longer term. So I think looking the other side, if you look at earnings last week, in terms of North American earnings and the U.S., they were very strong earnings. Companies are still guiding up. There hasn't been a lot of caution in terms of what the consumer is looking like. So that is yet to hit the markets. Of course, we've seen the Fed actually moving to a more of a pause. If we step back and look at the beginning of the year, there was cuts expected. Now we've moved to probably no cuts this year, which has been a real hamper in terms of the stock market being able to go up. So there's a lot of moving parts in the market today.
All right, we're going to take a break on that note there, Michael, but stick around. We've got lots to talk about, including Canadian bank stocks that have surged, but are investors now paying full price for safety and dividends? See how things are shaping up on the markets. We'll start with the U.S. futures. And, of course, it's been an up and down kind of morning so far with what is going on in Iran. The U.S. saying it's going to help ships get through as a humanitarian gesture. Iran saying it fired and hit a U.S. Navy ship. The U.S. has denied that. Markets have been all over the place with news. You can see it there. It's mixed right now. As for Asia, a lot of this unfolded after they closed. So you can see the Nikkei had an up day, 0.38%. Hang Seng up by 1.25%. And the CSI 300, it's about a wash for the day. Off to Europe now. And it's similar to what we're seeing with the U.S. futures. Mixed right now. Now they're all back in the red. They were at one point, Acheron was up slightly, but everybody's off right now. Or the DAX was up slightly, but everybody's off right now. FTSE by 0.14, Acheron by 0.85, and the DAX down by 0.09. Taking a look at the TSX on Friday. It had an off day, down by 0.22%, and finishing below 33,900. And taking the hit for most of that was materials and energy. They were both off by to 1.14%. All right, some of the winners and losers. Badger Infrastructure, look at that, up nearly 20%. Aya Gold and Silver, 6.75. Magna, off by 4.36% on its earnings report, and Fairfax down by 7.67%. And looking at the metals, all of them trending downward, not surprising with what's unfolding right now with the news coming out of Iran, but gold's up by 1.5%, silver's off by 3%, and now down, threatening to drop below 74. And copper is up by 1.3% roughly, and down below $6. Western Canadian Select. This was Friday, of course. Had a whole weekend since then, but it was up by nearly 4% to 78.67. And WTI, and you can see it's rising today, back up around 100, almost 104 barrel, up by 1.4%. So let's see what happens today. It's just another one of those days. Canada's big banks have enjoyed a powerful run, climbing 50 to 75% over the past years. Fundamentals stayed solid, but with valuations near the top of their historical range, investors may be looking at income returns rather than further upside. For more, let's have Michael Hagues from Murray Wealth Group join us to talk a little bit about why he thinks the banks are maybe priced to perfection right now. Michael, what your thoughts on what the banks are doing? They're always good, it seems, but they're too good right now.
Yeah, Roger, thanks for the question. It comes down to valuation, really. The banks are trading at approximately 13 times earnings. That's well above their long-term average of about 10.5, 10.6. And that's very close to the upper end of their historical trading range. And when you look at on another metric, price to book, they're trading at about 2 times price to book when you look at that long-term average of about 1.7. So not super extreme levels, but they're definitely fully valued, we think, especially given the low to mid-single digit kind of growth environment. And historically, when these banks are traded near these multiples, you can expect a period of flat or dividend-only returns over the next the period. So when you do look at those dividend yields, you can see that they're not as attractive as they once were 18 months ago. They're only around 3.5%, 4%, depending on the specific bank you're looking at.
And what's driving those numbers, the valuation and the growth?
Well, they've been benefiting from rates coming down and being very, very well positioned in terms of probably a safety sort of a trade. And a year or so ago, the dividend yields were very, very attractive. But just to point out where we may be moving to is that in Equifax last week did report some delinquency rates of some local areas, Brampton specifically, where delinquency rates on mortgages outstanding were 0.6% in Q4 last year, compared with 0.26, 0.3% nationally. That's a little flag, Brampton's a big market in terms of real estate and mortgages. And when you dig down below the covers in terms of other credit types, you can see credit card delinquencies are rising a little bit year over year. Auto loans are accelerating. Auto delinquency rates in terms of auto loans are accelerating also a little bit year over year. So mortgage payments are always the first things people pay. Those other ones, credit cards and auto loans, tend to be the ones that go first.
And are the numbers worrisome, or are they just kind of red flags where you're paying attention, or is it a trend you're seeing?
It's an orange flag. The banks are priced to perfection, I think. When we look forward for the rest of the year, we do have this nasty situation we talked about in Iran, and how the U.S. anyway, has moved to more of a neutral stance. Canada probably maybe, even though they flagged last week, they're gonna keep rates where they are, but they're probably restrictive at the rates where we're at right now. We still have CUSMA to renegotiate this year with the U.S. We still have tariff uncertainty that moves every day again. You have creeping unemployment approaching 7%. So there are some orange flags for banks that are fully valued.
All right, and with the bank rate and mortgage rates, what is it? I believe 60. You're going to see 60% of renewals over the next year. People are going to get hit Is that a big concern? And the rates are way higher than what they got their deals at 5 years ago.
No, that's exactly that. That's exactly the case. So people are enjoying those great monthly mortgage payments, whatever they are today, or going back when they locked in, and now they're renewing. Last year they renewed. This year they're renewing. Next year they're renewing. And every time they renew, they may have to have a $500 more per month in terms of mortgage payments. So that's going to take away from their consumer spending levels, and it's going to put a lot of pressure on consumers in Canada.
And what other, looking ahead, what other possible catalysts could there be over the next year?
For the banks?
Yeah.
Yeah, I think you need to see a resolution in Iran. You need to have rates expectedly to come down to get the consumer back on side. Gas prices have to come down. There has to be a general sentiment turn, feeling more positive.
That's a whole lot to unfold in the next year.
Yeah.
So where are you sitting? Are you underweight, overweight? Where are you sitting with the banks right now?
We don't really have we don't have a need to own the banks mentality. We look at them on their face value with their valuations, and right now they're all fully valued. We've actually exited all our Canadian banks from our Global Growth Fund. We still own a few banks in our Income Growth Fund as we see other opportunities elsewhere in terms of higher upside.
All right, we'll wrap it up on that note, Michael, but stick around. I know you're going to stay for the rest of the hour, and we're going to see why MasterCard is on Michael's radar. Time to see what's on the radar from Michael Hakes from the Murray Wealth Group, and MasterCard is the one showing up first. Michael, what are you liking about it?
Yeah, MasterCard really is no longer that transaction-driven payments company that we all know and love, along with Visa. You know, they're pivoting to a higher margin services type business that the market, we believe, hasn't fully priced in. The stock has been flat to down over the past year or so, but the valuation is super interesting here. They just reported last week. It was a strong quarter. They came in about 20 cents above what the street was expecting at $4.60. So the street was expecting $4.40. And a lot of that beat was driven by margin expansion. So that's really important because it reinforces that shift to that higher value, higher margin business. And one of those businesses is called their value added services business. And that segment grew at about 22%. And now represents about 35% of total MasterCard revenues. And when I talk about value-added services, that really means things like cybersecurity, real-time fraud detection. MasterCard also is using payment data to help retailers understand consumer behavior. So when a retailer does things like changes their menu items, they can track how consumers respond. They can track how pricing changes consumer habits. So it's really sticky, recurring, high revenue, high margin business.
So is this them conceding the credit card sector to Visa, or?
No, it's an add-on. Both of them are benefiting from these added services. But they're also adding more services to add another leg of growth for these companies. MasterCard, for example, also has what they call MasterCard Agent Pay. So we've all heard about potentially our having our own AI agents doing autonomous payments for us. So this MasterCard Agent Pay is their way of helping me, a consumer, get trust by making payments autonomously through my agents.
And now, is Visa doing similar, or are they keeping up?
They are keeping up. Have similar strategies. Visa has more exposure to North America, broadly speaking, and MasterCard has more exposure to emerging markets, which we like a little better. MasterCard specifically is only trading at about 26 times earnings now. When you look at historically, it's traded closer to 35 times earnings because it was an oligopoly with Visa. They would grow at low double-digit growth and 15% EPS growth, which they're still maintaining. But there's been a huge overhang in terms of the effects of stable coins and all these other financial services, digital financial services company that have added a bit of clouds to that clean story that was before.
All right, let's get on to the other two stocks. United Health, which has been beat up over the last year or so, hasn't it?
It has, but it's making a bit of a comeback, and we think it's super interesting right now because we think it's in that early stage of a turnaround. And we think there's a clear path actually, for earnings to recover to almost their prior peak potentially of around $30 a share over the next couple of years. And what makes it compelling is they've already worked through some of those issues you referred to, regulatory issues, cybersecurity issues that have weighed on these results. They just delivered a big Q1 beat, which we believe could be the beginning of many more beats in the time to come.
What are some of the things that they may still have to clear up or work through?
They're working through. The margins need to recover. Their medical cost ratios are improving, but not back to their historical best-in-class type margins. They've also they're also buying back stock now, which is good confidence for the management team. They're also scaling Gen AI tools where they can offer their 20 million members these new Gen AI tools, which will help with efficiencies with claims processing and underwriting. And a huge issue for them over the last couple of years has been Medicare Advantage and pricing, which they're resolving. They're taking some of the people who are non-profitable out of their Medicare Advantage base because of the pricing issues. They're resetting that whole thing. So if you do look forward and you blue-skied United Health over the next 3 years, and they hit that $30 in earnings and put a historical multiple of it of 19 times. 19 times is only a market multiple. It could go from the 370 it is today and go to 570 in 2 or 3 years, which is a 50% return, or if you put it on a yearly basis, a 15% compounded average growth rate. So that's sort of a blue sky look at United Health.
All right, let's get in Airbus. Boeing had a good quarter and some good numbers, especially orders. Airbus looking at the same?
Yeah, Airbus has roughly 60% share of the commercial aircraft market. Boeing is slightly less, but Airbus has this enormous backlog of over 9,000 aircraft, which gives them more of a decade of revenue visibility. That kind of visibility is incredibly rare in any industry. For Airbus, the focus is on production. So they've got this demand. They need to be able to make airplanes, which has been the real challenge for them over the last 2 or 3 years since COVID and their supply chain that they have to manage. They have a target this year of 870 aircraft. After Q1, which is a bit slow, they still need to deliver 750 planes. But the management team is super confident, hopefully super confident, that those supply chain constraints, which have been moved to actually engine supply, which is over the last quarter the tough one. But another catalyst for Airbus is delivering this new A321 XLR, which is the most anticipated, what they call narrow body aircraft in years. It's officially entering service. Air Canada just took delivery of the first plane in April. This is a narrow body that will offer transatlantic flights this summer, barring any kind of fuel shortages. But these narrow body aircraft are very efficient, super efficient, and they're able to land in different markets within Europe, for example.
Okay.
We think Airbus is super well positioned.
All right, we got to wrap it up there, Michael, but still ahead. As oil supply risks build, the UAE has made the official decision to exit OPEC. We'll break it down further, and our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email if you want. First call at bellmedia.ca. The U.S. is denying an Iranian media report about Tehran striking an American naval vessel with missiles. It happened hours after U.S. President Donald Trump said the U.S. will help ships stranded in the Persian Gulf transit the strait, calling it a humanitarian gesture. The plan left Ship's owners confused. There are very few details provided. In response, Iran's military said U.S. forces would be attacked if they entered the Strait of Hormuz. OPEC Plus nations have agreed to increase crude production slightly next month as the Iran war continues to impact global oil supply. During a virtual meeting on Sunday, the group decided to raise production by close to 200,000 barrels a day. However, the move is mostly symbolic because the Strait of Hormuz is not fully open. This will be the third consecutive monthly increase by the bloc. It comes after the United Arab Emirates' surprise exit from the bloc. We are watching shares of eBay and GameStop in the pre-market. GameStop is proposing to buy the e-commerce website for $56 billion US. Cash and stock offer from the gaming retail chain comes with a 20% premium. GameStop says it has secured a highly confident letter from TD Bank to provide about $20 billion US in debt financing and pledged to find about $2 billion US in annual savings within a year of closing. Taking a look at the markets, U.S. futures, you can see the Dow off by 0.33, Nasdaq's up ever so slightly, and the S&P 500 down by 0.12, all over what is unfolding in Iran. After their OPEC meeting yesterday, the UAE confirmed it's stepping away from the group, adding fresh uncertainty as tensions with Iran and shipping disruptions pressure global oil supply. Let's bring in Stuart Glickman, Energy Equity Analyst, Deputy Research Director at CFRA Research, and help unpack what unfolded there today, yesterday. Stuart, thanks very much for joining us. What was it? Was it a different meeting with the UAE not there, or was it business as usual?
So I think the other 7 participants who were in that meeting tried to carry it off as if it was business as usual. The extra 188,000 barrels a day on the quota that they've put forward essentially pretend as if the UAE was never there in the first place. So I think they're trying to carry it off as if everything's copacetic, but I think this is a shot across the bow for the cartel.
Michael, did you want to join in?
Stuart, nice to meet you. Hey, the UAE officials say that OPEC gives them more, leaving OPEC gives them more freedom to invest and expand. Is this really about growth or more about geopolitics?
So I think this has been a point of consternation between the UAE and and Saudi Arabia for several years, where the UAE has wanted to increase its production quota more than Saudi has allowed. And so I think the UAE has said, you know what, we're probably not going to find a better time to make this kind of move because to the point that was made earlier, this is symbolic at the moment. It's not possible for the UAE to actually expand its production, even if it wanted to, because it doesn't have an easy way of getting those extra barrels to market. So rather than announce that at a time when all the seaborne transit is going normally and running the risk of oil prices really dropping, this is a way of them sort of telegraphing what they would like to do in the future. And so it is sort of like a reference to the geopolitics, and that's why I think they chose this timing. And
what are the dangers of the Oh, sorry. Go ahead, Michael.
No, I was just following on with Stuart. So the UAE is outlining capacity close to 5 million barrels by 2027. It seems like you're skeptical. Is that credible for the UAE?
So I would say it's not credible for 26. I think it is pretty credible for 27. I think it ultimately comes down to how long do you think the Strait of Hormuz is going to remain constrained? And we would argue that the reopening of the strait in some form that looks like what it did pre-war, that's probably a 2027 event. Now, if they wanted to, let's say the strait is opened and they wanted to move their production up, currently they're at, I believe their capacity is around 3.7 million barrels a day. It wouldn't take a huge amount of effort to get up to 5, but the limiting factor, of course, is how do you get your barrels to market? Because the Strait of Hormuz is sort of like the seaborne cul-de-sac, and there's no other outlet aside from moving it out of the strait. And if you have blockades, you can't do that.
And now the UAE just announced that $55 billion on new projects yesterday. Funny, just as OPEC was meeting. Will that help, or is that just a bit of grandstanding right now with everything that's unfolding?
Yeah, I think it's a little bit of grandstanding. The one thing that the UAE could do down the road, and this is longer term, they do have a pipeline. That's I'll call it the Abu Dhabi pipeline that moves about 1.5 million barrels a day from Abu Dhabi to the coast, and it's a little bit east of the Strait of Hormuz. So that is an option if they wanted to expand that, but that would take time. And in the interim, I think this is a little bit just sort of, suggesting down the road this is what they would like to do, and telling Saudi that they don't, that they can control their own destiny.
And I mean, and obviously they've been butting heads for a while. Could this escalate politically and beyond between Saudi Arabia and the UAE?
Well, I think if you're Saudi, I think your fear has to be that other cartel participants watch what the UAE is doing and saying, we can chart our own course too. Now, to be fair, the UAE is in a slightly different situation. They are much less beholden to oil markets than are some of the other participants in OPEC. So I think it's only about 25% of the economy is tied to crude oil in the UAE. The other 75% is more about innovation and tourism. So they probably they're starting from a position of strength, I would argue, that they can kind of take this move and risk the potential wrath of Saudi Arabia more easily than other participants could. But if you're Saudi and your goal for years has been to be a price hawk and make sure that everyone's living up to their end of the bargain, this makes life more difficult.
Could we see, is there any other OPEC member that could jump ship?
I don't see any at this point in time. And we've had other small fry leave the fold. So Angola was one. So that was only a couple of years ago. But I don't see anybody that's really meaningful in the same way that the UAE is taking the step.
And so what's next for the UAE and Saudi Arabia? Will they work together at all on anything, or is it just done now?
So I would say there's some non-zero chance here that this is an elaborate bluff by the UAE in an effort to boost their production quota to the level that they would like and get them to come back into the fold. So that's a possibility. I think it's a less than 50% chance. And I think that, the UAE probably did not undertake this move lightly, even if it's a bluff. And so I would say that the geopolitical relationship between Saudi and the UAE is probably, if it's not broken, it's at least strained.
Okay, we'll leave it there, Stuart, but thank you very much for joining us.
Thank you.
Stuart Glickman is Energy Equity Analyst, Deputy Research Director at CFRA Research, helping unpack the implications of that deal. Coming up next, the meme stock madness to mega deal ambitions. GameStop making a stunning $56 billion play for eBay. We'll have more on that after the break. And our phone lines are open. Michael Hakes is taking your questions on global stocks. Call us at 1-855-326-6266, or you can email us. First call at bellmedia.ca. All right. And GameStop is pitching a bold $56 billion takeover of eBay, offering cash and stock in a deal that would vault the meme stock favorite into the top tier of global e-commerce. While eBay shares are jumping, investors are questioning whether Ryan Cohen can pull off an acquisition several times the size of his own company. For more on this, let's bring in Cecilia D'Anastasio, the video games reporter at Bloomberg News. Cecilia, thank you very much for joining us.
Thank you for having me.
Is this realistic? Does it feel like this could actually have some real legs to it?
As you pointed out, eBay is several times larger than GameStop, and GameStop has had a large desire to be present in the press over the last several years. Analysts are concerned that the deal won't go through, and Ryan Cohen, the chief executive officer of GameStop, has said that he has received a highly confident letter from TD Bank to provide $20 billion in debt financing. So all these factors together are leading people to be a little skeptical that eventually he'll be able to stick this off.
Is that too short? Because I think they have about $10 billion in cash, and they said they could see $2 billion in savings. Is that anywhere near enough, or do people want to see enough the money for what they're offering?
I think people are a little bit confused about how the math will math with this one.
And it's simply not mathing at all. Is there a reason why they might do this? Why they might put this offer in? What would be the benefits of this merger?
Yes, GameStop has been decreasing its footprint in its retail locations for the last several years as gamers increasingly purchase their video games in digital marketplaces. GameStop has had a variety of different strategies to combat this challenge, including trying to move into esports, trying to move into e-commerce, which is CEO Ryan Cohen's background. He was the co-founder of Chewy. And while the company's done better than many people expected, it hasn't really found anything that's going to lead to sustainable growth in the future. So Ryan Cohen believes that if he was running eBay, he said to CNBC this morning, it would make a lot more money. And we're just going to wait and listen to see what that looks like in his mind.
And did he expand on how it would make a lot more money? What they would do to be different?
He did not at that time.
So we're just kind of waiting. Have we ever seen any other situation like this where a smaller company takes over a bigger one without full funding, like without having the actual amount that they want to buy it for?
I'm hard pressed to think of that, but Ryan Cohen is definitely an innovative presence. He was in charge of GameStop during the meme stock frenzy, which GameStop was able to capitalize on pretty effectively over the last couple of years. The company is a big challenge, but he seems like someone who's excited to try and make it work.
All right, but for now, it looks like it may not have the legs to get through.
That's what analysts are saying.
Okay, awesome, Cecilia. Thank you very much for joining us.
Thank you for having me.
That was Bloomberg's Cecilia D'Anastasio. And now for the investment side on this, let's bring in Michael Hakes. Michael, your thoughts on this? A meme stock that wants to buy the real thing.
I know, it's amazing. But, they have a letter. They may have a letter from TD. That's really a good thing for $20 billion. But I think, that was sarcasm.
Okay.
Just to make sure.
Wait a minute.
That's the surprising part of the whole thing is, first of all, good point earlier. Why are they doing this? And this makes no sense. GameStop, well, maybe it makes sense as a Hail Mary from Ryan Cohen, but GameStop has been in closure mode for the last 2 years because their business model is under pressure. They've gone from, I think, 3,000 stores to 1,500 stores. So they're right-sizing the business. No one's going to be going to stores in the next 10 years, which is the offering they have now. So they're pivoting. If I was and I think the deal is 50-50. So one day, if this deal goes through, I'm going to be an eBay shareholder, and I'm going to wake up one morning, and I'm going to have some cash, and then I'm going to have GameStop stock in my portfolio.
Not easy to say on a Monday morning.
Yeah. So then have to base my confidence on Ryan Cohen taking eBay to new levels where, quite frankly, eBay has been okay. It's a slow and steady grower. It grows at 5 to 10%, maybe 5%. It's got some strong margins. It is in turnaround mode, but grows its EPS if analysts are right, 10% per year. Only trading at 16 times. It's slow and steady. It's not a rocket ship, but trades at
okay.
The deal doesn't really make any sense to me as to why you do this.
All right, we'll wrap it up on that note there. I think a lot of people are agreeing on that. We'll take a look coming up at some of the notable analyst calls and recommendations moving the markets, including an upgrade for Airbnb. let's take a look at some of the notable analyst calls and recommendations. Airbnb shares are up slightly in the pre-market after Oppenheimer raised its rating to outperform with a price target of US 180. The analyst saying new products like hotel listings and AI-powered searches should help Airbnb grow revenue faster than expected. Oppenheimer also noted the company is well positioned to handle travel disruptions and could benefit from increased demand around the World Cup. BMO Capital raising its price target on TFI International to 140 US from 115 while keeping a market perform rating. The firm saying signs across the transportation sector, including demand indicators and recent company results, point to improving conditions. BMO also noted better shipment volumes and weights in the less than truckload market, leading it to lift estimates and price targets across the group. And Scotiabank raising its rating on TD Bank to outperform, increasing its price target to 150 Canadian from 142. The firm believes TD is well positioned to control costs at a time when revenue growth may slow. This is especially important as higher interest rates and high debt levels in Canada could pressure earnings. Scotiabank also notes TD has more room than its peers to reduce the number of branches and save money. When we come back, Michael Hakes will be taking your questions on First Call. All right, time for First Call and first email as well. That's from Mike. And would you be a buyer of Meta Platforms on this pullback? Michael, would you?
Yeah, Mike, that's a great question. We like Meta here. We would be buying it. It's very cheap, trading at only like 19 times earnings, growing at, if you believe the numbers, over 20% this year, and then high teens for the next few years. They reported their numbers last week. The market was not impressed given the Google's home run earnings. But Meta really only came in line in terms of expectations, and also their capex was higher than people expected. So that wasn't the recipe for the stock going up, at least this quarter. Meta also announced cuts to their workers, so they're cutting because they're seeing benefits of Gen AI. But the real thing is that they haven't seen the revenues come through in terms of all the spending yet, whereas Google did see the revenues come through, which is a good thing for ROIC, which is what the market is laser-like focused on, is returns on all this capital they're spending on the data centers. So that's key. We like Meta here at these cheaper levels. And hopefully over the next 6, 9, 12 months, they'll show the revenues that the other players have started to show.
All right, let's get another email in. This one's from Tony. What's your take on TELUS and the telecom sector for 2026?
Yeah, thanks a lot for that question. TELUS has the highest yield in the group anyway, up at almost 10% yield. Growing very slowly, new CEOs taken over. Last year, if you look back last year, they made a pause in the dividend growth, which is the right thing to do. It's widely expected that they will probably cut the dividend. Then the real question is, where does the stock go on that announcement that everyone's expecting? Hopefully it's not down too much. But having a 10% yield kind of tells you a company that should only return maybe 6 or 7% to investors. There's a disconnect there because it's, to your point, the telecom industry is kind of a zero-sum game. You only have so many people who can take telecom services. It's a very, very competitive industry. Pricing is not fixed. Price is probably under pressure, especially given maybe some satellite competition coming in over the longer term, which hasn't happened before. So it's a difficult industry. I'm cautious on telecom overall, even though it seems very attractive. I don't get too excited.
All right, let's get to another email, and this one's from David. Is ServiceNow a falling knife or a buy?
Well, we definitely think it's a buy here, even though it looks like by the chart a falling knife. They've caught definitely the SaaS disease.
Mm-hmm.
They are in a laser-like focus in terms of the impact that Gen AI is going to have on SaaS companies, and it really comes down to this: ServiceNow charges people now on a seat basis. Let's say I pay $50 a month for my seat, and ServiceNow takes that money and just develops their business and has more coders coming in and develops more software. However, now with the Gen AI and the automation that they can provide, they will have to ServiceNow, if they want to leverage Gen AI, they will have to pay the large language models for these autonomous agents. So they'll essentially move from a seat-based business model to more of a consumption-based, outcome-based business model, which is super interesting. But there's a lot of overhang because of that.
I've got one last quick thought. I got to wrap you up. You got about 5 seconds.
Yeah.
Stay away.
So 5 seconds. So I would say pricing outcomes could move to a shift from paying $50 a month to let's say $1 per resolved ticket.
That's 10 seconds.
Okay.
I got to cut you off, Michael.
Okay.
We're out of time, but thank you as always for joining us on The Street. Michael Hakes, Senior Portfolio Manager at Maury Wealth Group. Lindsay's up next with The Open. Have a great day.